The software is designed to show you these scenarios that you see on the right-hand side of my screen. And that would be number one, both clients die immediately on their vacation right after you plan their estate. Is there an estate tax? And you see here, Bob and Mary Noter in the middle. They have a residence worth $1 million that's going to grow at 2.28% a year. They have investments of $9 million, which are going to grow at 9.73% a year, minus costs of 1.5% a year. And they also are saving $400,000 a year until Bob dies. And once Bob dies, let's go to no planning. This shows you that Bob dies in the year 2017. The house is now worth $1,467,000. The investments in year 17 are $51 million because of the time value of money and the $400,000 a year savings. And on Mary's death, many years later, the estate tax is $19 million. So those are the first two screens. The third screen is, what if a bypass trust was set up when Bob died? That brings the estate tax down to $18 million. You see what can go into the bypass trust and what bypasses estate tax. And then, do they do annual gifting to an irrevocable trust? If they do the gifting in cash, would it be better to do it on a discounted basis? Will they have a life insurance trust? And then finally, will they consider an installment sale? So I go to the left side of the screen, and I can play the bypass trust here for you. And on the left side of the screen are the inputs. The first input is your law firm name. I've got South Bend, and then the name of the planner. I've got Lawyer Indiana. And then for each spouse, I've got the first name, the last name, the age, whether they're male or female. And then this will tell me the life expectancy based upon whether they smoke or don't smoke. And then I can dial in the year that I want Bob to die. Right now it's at 2037. I can arrow that up to 2040, give him longer to live, or I can arrow it down to 2036, give him less time to live. And what you're noticing here is, while I'm changing his age, his date of death, all the numbers on the illustration are changing because the computer program is keeping track of every scenario as to every aspect of this. So then I go to her, I go to the wife.
Alan, let me interrupt.
Sure.
Alan, one of the things, when you use the commercially available programs and they do their illustrations, they always use the individual's life expectancy. So for example, and they use the life expectancy using out-of-date mortality tables. So if you have someone age 70, their life expectancy is 14 years. So the commercial programs will do a projection over 14 years. But 14 years mean there's a 50% probability they'll still be alive. And our clients who do sophisticated planning are in better health and have access to better health care. So this allows you to do your financial projections beyond what the commercial programs do, because you can put in up to age 95 or whatever you want. So that's one of the advantages of Alan's software over the commercial programs. Back to you, Alan.
Thank you. So then we'll put in that they have $1 million home growing at 2.27%. If they say, wait a minute, I think my home's going to grow at 4%, fine, we can have it grow at 4%. If they say the home's worth less, fine, we can have the home worth less. Then their investment assets, rate of return, tax rate as a percentage of the assets, costs, annual savings until the first death, and annual savings or losses if they spend more than they make after the second death. Then the question is, do you think the exemption is going to go down to half in 2021? And if I click the button here, you see 17 million of estate tax, or 9 million, depending upon whether the exemption is going to go down or not in 2026. So obviously, this is very important. And then the next box, will portability be available? Will the surviving spouse remarry and lose the portability allowance? And it'll keep track of that for you either way. Then the maximum amount, do you want to max fund your credit shelter trust? You can go ahead and do that versus using portability. Then how much is already in an irrevocable trust for descendants? In this case, we could say 0, or we could say 750,000. How many children and grandchildren do they have for crummy powers? And is their gifting going to be all of discounted interest? And what is the discount we're going to be using? In this case, it could be a 25% discount. And we could say that 80% of their gifting will be discounted LLC interest, 20% will be cash. I'm going to skip the life insurance, but we can also have the before and after planning for each spouse on their life insurance situation. And then finally, there's the question of whether they will do an installment sale. So let's see what these people look like. I can now tell them if they both die right away, there's no estate tax. There's a relatively small estate considering there's a $22 million exemption. But if they do no planning and they live until the years we've talked about, $22 million estate tax. If they use the credit shelter trust, comes down to 17 million. If they'll do some annual gifting, comes down to 12 million. If they discount with the gifting, comes down to 11 million. But what about an installment sale now? And that's what Jerry really has taught me as a very important lesson, is the power of the installment sale to a defective grant or trust. So let's say that they put in a $250,000 seed capital gift, and they put $2,500,000 worth of assets into an LLC. Actually, if we take 30% discount and they put $4,250,000 into the LLC, they take a 30% discount. That's a $2,975,000 transfer. I will increase the seed capital gift to $500,000. I'll click here under installment sale, and their estate tax has gone down to $3,008,000. Now, if I want to show them complete savings here, I can go back and I can increase the installment sale. I can increase the seed capital gift, and I can increase the installment sale until the estate tax goes away. So now I know that based upon these assumptions, if I put $4,550,000 in an LLC, take a 30% discount, a $750,000 seed capital gift, I've eliminated the estate tax based on these scenarios. But
Alan, let me interrupt.
yes.
Alan, let me. When we do our recommendations for potential clients, and we get into grats and charitable trusts and installment sales and beat its, you name it, the client really wants to know in 5 minutes one thing and one thing only. What is that what the client wants to know within 5 minutes, Alan?
How much tax will I pay?
Right. And what happens is when you have the numbers kind of pre-programmed in, and remember you can change them as the client says, what about this? But if you have the numbers pre-programmed in and you show no tax planning, and then you show with tax planning, within 5 minutes, you can show the client that this is the amount of money you're going to save in estate taxes without getting into an explanation of what techniques you're going to use. In other words, you have to meet the 5-minute test. And once they see all the money that can be saved in estate taxes, then they'll say, how do you do it? And that's when it comes into going into the details. But you still have to use simple to follow numerical examples so that they can follow through how it actually works. And we're going to show you an example of that shortly.
Perfect. So now I want to take you back to the installment sale, because we've also, at Jerry's suggestion, we're showing some other things. We're showing the interest rate on the note, which could be either a conventional note or a self-canceling installment note. You will then go to Tiger Tables or Number Cruncher or whatever your source is to determine the interest rate to use. And then we can also have grantor trust status toggled off in any given year. We can also provide, if you're going to transfer a business to this trust, is there going to be just additional income coming from the business in addition to the growth, and for how many years? Because a lot of clients have businesses that they'll consider that they'll continue with. Now, the next thing you can do with this is you can view it as a timeline. So I'm showing you the same thing here. If there's no planning, then these are the years beginning in 2025 when the estate tax will be imposed, and the red is the estate tax. Whereas if they do the credit shelter trust, that is the bottom part is the credit shelter trust, and you saw that the red got less. Annual gifting, the red gets less. Counted gifting, the red gets less. But it doesn't disappear until we do the installment sale. Now, they would say, what if I die earlier? Okay, I'm going to move your date of death just like that. So now I can test my techniques based upon when the date of death is. Sure, if you die soon enough, there's your estate tax on your date of death. Jerry, any questions or comments so far?
Yeah. The key is software and all these programs are only as good as your ability to communicate in an understandable manner. And what Alan has done, or his son-in-law has done, is design it in a way to improve our communication skills.
Right.
And it's hard to do. Go back out.
Yep. So now I'm going to show you the neatest thing. I go here and I click on Generate Client Letter. And right now, immediately, a letter has been drafted to the client, which exactly matches what you've just seen. It explains the system to the client. It gives them all the exact inputs that we just used. And it gives them the explanation and the same illustrations. So you can print that, you can save it as a Word document. This letter used to take us 2 or 3 billable hours to draft. Now it takes half an hour once we customize it after the computer has drawn it. Now, if you are looking at 2 different scenarios, you would print one letter for one scenario, one letter for the other scenario, and then show the client these letters side by side. If there is portability, if there isn't portability, if the exemption does go down. Now, we will be updating this software at no charge when the estate tax exemption amount changes. That's going to be, of course, at least January 1st, but it may change again once we get election results. The final thing that the software does, besides being able to save all of these calculations and all of these screenshots separately, is there is a separate installment sale calculator where the numbers are shown for the client and for you on a year-by-year basis for a single individual. The EstateView module that I just showed you is always for a married couple. If you have a single person, quite honestly, you have to kill off the first spouse in day 1 and then measure the second spouse. But for an installment sale, this would be for a single individual, whether married or not. Assets before you start, assets separate from the note, growth of the assets, annual savings or spending, how much is the note payment, what is the income tax on the income of the trust, when would you toggle off or toggle on, what is the taxable income? Yes.
The most important thing in wealth depletion is not the discounts and not to be able to earn a greater rate of return than the interest on the note, but what we call the burn. And if you look at the amount of income taxes that the grantor has to pay each year on the trust income, and you look at that column and you show the client that column, and the client says, wait a minute, look at that, the income taxes, and the client says, you know, there's a point in time where enough is enough. And the client says, I want to toggle off grantor trust status. But the idea is you're able to show the client the financial impact of the discount, the financial leverage, and the grantor trust burn in a nice, easy to follow visual example with the spreadsheets. And then when the client looks at the assets building up in the trust, and he sees what assets can build up in the trust, it's a nice way of communicating this very sophisticated technique without getting into technical details. And here's what's very important. There's been several cases in the last few years where the grantor has told the trustee, I'm tired of the burn, turn off grantor trust status. And the trustee says, I don't have any fiduciary duty to you as the grantor. I have a fiduciary duty of fair dealing for the best interests of the beneficiaries. And two cases, one in, I think, Wisconsin, and I forgot the other state, where the grantor wanted to order the trustee to turn off grantor trust status, and the trustee said no. The grantor went to court, and the court said no. The trustee has a duty only to the beneficiaries to maximize their benefits. And so what you can do is you show the client the potential here, and to avoid that problem, the client can say, you know, in year 20, that's enough. So you put in the trust document an automatic provision where the power that creates grantor trust status terminates by operation of the trust instrument, so the grantor has total control over it and avoids the problem of the trustee saying, I'm not going to do it. Back to you, Alan.
Can't hurt to have some trust protectors in there also. The software also allows you to move any of these illustrations or any of these parts out to separate screens. So if you have a dual screen computer, you could have the input one place and the illustration elsewhere.